In this video, we'll be discussing the options chain. This is the tool that you'll use to place options trades. Having a basic understanding of how it works is really important. So let's begin the walkthrough so that you can start placing options trades. So let's talk about the options chain. This is where you're going to be placing your orders. So it's good to understand what's included in it and just have a general overview of how to utilize it. So as this states, the visual representation of all available option contracts for an underlying asset is what the options chain is. It's what the option chain represents, and it's where you're going to be spending a lot of your time when you're trading options. So what does it include? It includes the underlying asset. It includes strike prices. And let me back up for a second. The underlying asset, if you're unfamiliar with what I'm saying here, is just the stock itself, right? So if you're trading Apple, Apple is the underlying asset. And then we've got strike prices, we've got expiration dates, we've got the call option side, the put option side, the bid and ask prices, volume, open interest, implied volatility, and the Greeks. Now, this is a lot of information. This is a lot that goes into what's on the options chain. We're going to focus on just a few specific ones right now, just to kind of get your foot in the door so that you understand kind of where you should be looking and where you should be clicking and placing orders on your options chain. But for the most part, this is what it includes, and we'll dive into each component a little bit further, but for the sake of this video and not making it too long for you guys, let's just talk about a few of them. So let's go over strike prices. So we've got three different types of strike prices. We have out of the money, at the money, and in the money. So when you see these abbreviations, that's what that stands for: out of the money, at the money, and in the money. These are the prices that you can pick on your options chain, and we'll go over each one of them so that you understand what they mean. So an out of the money strike price goes like this. If you buy a call and the stock is at 100 and the strike price is at 105, then you're out of the money. Reason being, if you buy a call and the stock is sitting here, we'll say this is $100, right? And here's your strike price up here at 105. Anything above the $100 strike price when buying a call is going to be out of the money because the stock isn't there yet price-wise. So we're buying something that's out of the money. Now, if you buy an at the money call, so you buy a call, the stock is at $100 and the strike price is $100, which is at the money of the current stock. Right? So simple as that. So if the stock is at $100 and you buy, here's the stock, and you buy the option contract at $100, you're at the money. Now, in the money can be confusing for some people because the term in the money sometimes makes people think that when you say in the money, that your P&L is in the money. This is not what in the money means. What in the money means is if you buy a call and the stock is at $100, so same scenario, stock's at $100, and the strike price of the call that you buy is down here at 95, and you're looking for the stock to go up, right? Then this contract down here is already in the money. It has intrinsic value. So it's already been at 95, then it went to 96, 97, 98, 99, and because we're looking at prices to go up with calls, this contract price would be considered in the money because it is below $100. So out of the money when you're above $100, at the money when you're at $100, and in the money when you're below $100. This is what it means if you're buying calls that are out of the money, at the money, and in the money. For expiration dates, we have a handful of different ones to choose from, and it's really going to depend on your strategy. Same with the strike price that you choose, that also depends on your strategy. So with options, you have options, right? That is why they have the name that they have. So for expiration dates, we have the daily expiration, which is going to come down to a lot of the more indexes, the ETFs. So you'll see a daily expiration on things like SPY, SPX, the Qs, and so on. Weeklies you'll see on most normal stocks. So I'm talking, Apple, Tesla, Nvidia, things like that. The SPY and Q expiration, even though they have a daily, they will also have a weekly. Then you've got monthlies, you've got quarterlies, and you've got leaps. So these are the long-term ones. People are looking out far into the future. We're talking like, anywhere from a year or so in the future. So this really, again, comes down to what strategy you're trading and what you like to trade, but just know that you have different expiration dates that you can choose from. Okay, so let's go ahead and take a look at the options chain just kind of in action here. Now, option chains will look different depending on the platform that you're using. This is Trader Workstation from Interactive Brokers, and most of the information that you see on here you will find on your platform, depending on which one it is, of course. But Mostly what we're looking at is a lot of the same things. So let's walk through this. So right now mine is sitting on Apple and I've got the calls queued up. So you'll see here, I just have calls showing right now just to kind of make this a little bit more simple. I can show you both calls and puts here in a moment. But what we're looking at here is the strike, right? So this is the strike that you want to purchase the contract at. Then we've got the bid and ask over here. We've got volume, we've got open interest, and then we've got all the Greeks over here. Right, so we'll go through those at some point, but just for now, just to show you kind of where they sit on your option chain, this is what you're looking at. Now, the expiration dates will be up here, right? So what we can see today on Apple is tomorrow is Friday. So we have 1 day until expiration. So this is a 1 day contract here. But typically Apple has weeklies and monthlies and so on. And what you'll see here is the next expiration date for Apple is a week from tomorrow. So it'll be next Friday. And then the one after that and the one after that. So I've gone ahead and I've just switched over to SPY to show you the difference and how the contract's expiration dates look for something that does trade on the daily. And what you'll notice is that we have an expiration date for today, we have one for tomorrow, and then we actually have a 3-day weekend. So the next one is on Tuesday, and then Wednesday, and then so on. And if you hit this little drop down here, you'll be able to pick further out in time as well. You can pick weeklies, monthlies, and so on. Now I can go ahead and I can put this on puts and calls so you can see both sides of what's going on. And what you'll notice here is that on one side, I've got the puts, right? So we've got puts on this side. It has the bid and the ask, the volume, the open interest, the Greeks. And then on this side, same thing. The expiration dates will all be right here still, but you can see the strike price in the middle, and then you see the calls on one side and the puts on the other side. Now let's take a look at what we talked about earlier between out of the money, at the money, and in the money. So every platform will be a little bit different, but what you can see up here on Trader Workstation is that the last price that the SPY traded at was $4.50.89. So right now, the call and put options right around $4.50 are going to be considered at the money. Now, as we start to go up the options chain on the strike prices, what we'll notice is the calls become more expensive. This is because all of these prices are under $4.50, meaning they're in the money. So $4.50 is at the money, but everything above here is in the money. Now, if we look at the put side, what you'll notice is when you go up the options chain is that all of these options become cheaper. And that's because everything below $4.50 right now for the put side is considered out of the money because it's the opposite direction. So these contracts become a little bit cheaper. Now going the other direction, down the options chain through the strike prices, as the contracts become more expensive, the calls become cheaper because these would be calls that are out of the money. However, on the other side, the puts become more expensive because the price is above the current price and those puts have intrinsic value and they're in the money. Now, for example, if I wanted to buy a call that was slightly out of the money, I would look over here and I would choose a strike, maybe that was $2, maybe $4 out of the money, whatever my strategy is. And I would click over here and I would buy that contract. So I would buy the contract that's slightly out of the money. And if I wanted to buy a put that's slightly in the money, I might go to the 454s over here and buy this put that's slightly in the money. You'll notice how when I clicked on the ask side of the bid and ask column on the options chain, on both the call and the put, I ended up with a buy order ready to execute. One other thing to mention that you'll notice on the option chain is up here in the right-hand corner, you will see IV, which stands for implied volatility. We'll walk through that in another video, but just know that that's where you're going to find it as well. It'll be on your option chain, and you can utilize that in your strategies. So there's a lot of different information in the options chain. I don't want to overwhelm you with all the things that it can do, but just know that this is a good general overview to kind of get you started, right? You want to know where your strikes are, what your strike price is. You want to know what the current bid and ask is on that strike price. You want to know volume. You want to know whether you're buying a call or a put. And that's kind of just the basic breakdown of how it works. Now, we'll get into more ways to use the options chain and different types of strategies that you can put on with it and how to build them in there. But this is the first simple overview just so that you can get your foot in the door when you're ready to put on a put position or a call position. You should now have a basic understanding of how the options chain works. We recommend that you familiarize yourself with the options chain and begin placing trades in the simulator. Thanks for watching, and be sure to like and subscribe if you're enjoying these options for beginner videos.